Good evening, everyone, and welcome to this evening's presentation on the latest on HOOPP and the offerings that have been that we've been made aware of since the end of November. I'm Jonathan Tucker, and I'm joined this evening by Banasha Shaw. Banasha is an associate of mine. She is a consulting actuary, and so this evening our hope was that we could walk you through the offering that HOOPP has brought to incorporated Ontario physicians and answer some of your questions. So to take some of the information that you may have read that may not have made a lot of sense and make sense of it for you. All right, we will work through our slides, and then as you have questions, we'll have a Q&A at the end. So Banasha, you ready?
All ready.
All right, let's do this. We just have a disclaimer just to let you know about the limitations of this information. So just be aware of that. And then here's an outline of what we're going to be going through tonight. So you can see what we will be ticking off as we go through. And then hopefully, if we've done our job properly, we won't have a lot of questions. But I feel like there's going to be a lot of questions.
I think there will be.
Yeah, I think you're right. All right. So a lot of the slides that you'll see in our presentation you will have seen from the HOOPP website, and that's deliberate. We want to now take those and examine them and so make sense of it. So we're not trying to put slides in front of you that are text heavy. We're trying to take what you've already looked and make sense of them. So, but just as we start, I'm going to assume most people don't know the different types of pension plans. So we wanted to give you an overview in terms of what are the typical types of pension plans that are available. What's normal? When I was a kid, my parents said, when you get older and you start working, go and get a job with the government or become a teacher, because you'll get paid a decent salary and then there will be a good pension to take care of you in your old age. And what they didn't necessarily realize was that they were talking about a defined benefit pension plan, and that is one where if you contribute to it a certain amount through the course of your career, they will pay you a defined benefit or a defined amount at the end. So that's known as a defined benefit pension plan, and that's what HOOPP offers. And if you want to think of another plan that's like that, Canada Pension Plan is like that. You pay in a certain amount based on your earnings each year, and when you reach retirement age, then you are guaranteed a certain amount of money for the rest of your life. Now that was a much more popular type of pension in years past, but it's really expensive for employers, because an employer is saying, we're going to make sure that there's enough money in the fund to pay out a defined amount in your retirement. So the trending around pensions now has gone to defined contribution pension plans. Those are the more normal types of pension plans that you would find just in the private sector, where the employer will say, Jonathan, you put 5% of your salary and we'll match that. So the contribution is defined, but the payout is not. So what we're talking about here with the HOOPP offering is a defined benefit pension plan. It's much more secure. It's not 100% secure. There's still things that can go wrong, but we wanted to look at this particular plan because independent of each other, we both heard about this, looked at it and thought, wow, that's a great plan.
Yeah.
But we neither of us can participate. We picked the wrong professions. So, but nonetheless, we wanted to just walk you through it because it caught our attention and we were getting dozens of questions about it, and so that's the reason we're doing this presentation this evening. All right, so we've talked about what the difference between a defined benefit plan is and a defined contribution. With a defined contribution plan, the contribution up front is defined, but whatever's in the plan at the end, who knows? So there's no security, whereas with a plan like this, the benefit is defined. And so if you're going to get into a plan that is a defined benefit plan, then there are some things you should be thinking about in terms of like the characteristics. I remember, Banasha, when you and I were looking at insurance policies for example, and you would say to me, oh yeah, but I wouldn't buy a policy from that company or from this company. And for the first time, it was like, I never really thought about the importance of the insurance company. Well, it's kind of the same with pension plans, right?
Yeah, that's right.
I mean, there are pension plans, you will have seen them in the last couple of years, they've been brought out, and we've looked at them, nothing really caught our attention except this one.
That's right.
Right?
Yeah.
So if you're thinking, well, should I be contributing? We've put the top factors, or what we call the top 10 factors to consider when evaluating a plan, because this isn't the only plan that's out there. So you can take these and compare other plans, so that we're giving you a way of thinking about how to look at a defined pension plan. I'm doing all the talking here. What do you think? Can you walk us through some of these?
Sure. Okay. So if you were to look at participating in a defined benefit pension plan, obviously the most important thing is to ensure that the plan is well funded and it's solvent. So this generally means that there's a certain amount of assets that are in the plan, that they do the regular actuarial reporting. They can ensure and they can attest that the assets that are in the plan are sufficient to fund all expected future benefits.
So they can value that.
That's
they can
right.
say, here's all the members and here's the value of what we're going to pay out.
Yeah.
And then if it's solvent, that means there's at least that amount of money.
Yeah, that's
available.
at least 100%.
And what's HOOPP?
HOOPP solvency ratio is 115%.
Wow, so it's got more than enough. It's got 15% more than
That's
what it
right.
needs.
Yeah,
Okay.
at this point in time.
Okay.
Yeah.
All right. Then benefit formula.
Okay. So the benefit formula is really important because Jonathan was talking about the difference between defined benefit and defined contribution. Benefit formulas in defined benefit plans are generally based on salary. So it's either based on a final average salary or a career average salary. Okay, and then it generally will include adjustments that are for inflation in salary, and then also indexation once the benefit is in pay. So the nice thing about this is, unlike a defined contribution plan where you retire, you have your pot of money. It may have done very well with investments. It may not have. But at the end of the day, you have to live off that pot of money. With a defined benefit plan, you have a formula and you know every year what your actual payout is going to be from that plan. You don't take any of the investment risk.
And is it adjusted? Or what happens with inflation, for example?
So during the payout?
Yes.
Yes.
So when people are retired, when they're collecting.
Yeah. So different defined benefit plans have different provisions. Some have it built into the plan document that pensions will be fully indexed to CPI or a percentage of CPI. With HOOPP, it is actually not guaranteed, but they have made CPI adjustments for the last 20 years.
So for people that are collecting their pensions that are with HOOPP, they've received what they've been entitled to and then some?
Oh yeah, yeah.
And that's been for the last 20 years?
For the last 20 years.
Okay, now, but to play the opposite side,
Okay.
The plan's been around how long?
60 years.
60 years.
60 plus years.
Okay, all right. So still, for the last 20, that's not a bad track
It's not
record.
a bad track record.
Okay.
Yeah, especially when you consider the last 3 indexations were, I think, 6% last year, 4% the prior year, and 3% the year before.
So what's that mean?
So that means whatever pension someone was earning 3 years ago was increased by 3%
Okay.
in the first year,
Okay.
increased another 4% the next year, and then last year it was increased another 6%.
Okay.
And once it's increased, it's not going down.
It's
again.
fixed. That becomes the new base.
That's right. So even if they do not provide another CPI increase, whatever has been provided to date is locked in.
All right. We're trying to be as balanced on this plan as possible, in spite of the fact that both of us thought when we saw this coming out, wow, this is really a great plan.
Mm-hmm.
But we're not here to sell you on this. This is here for information. But I'm just, by way of comparison, we looked at this and immediately thought, wow, we'd love to be part of that plan because it's got a good reputation. It's well known, right?
Yeah, it's established.
So first thing to think about is how well funded is the plan itself? Is it solvent? then the benefit formula, then we get into contribution structure. So the employee and the employer contribution. Can you shed some light on that?
So generally, any member of HOOPP or any pension plan would have to make contributions into the plan. So that would come off of their salary. So with defined benefit pension plans, these contributions tend to be in the range of 7 to 12% for the employee, okay, depending on the pension plan itself. Then the employer will also provide a contribution. Again, in the case of HOOPP, we'll go into the details on that in a minute. So between the two, the employee contribution and the employer contribution, those are added together each year, added to the fund, and they are then invested and will eventually be there to pay out benefits in the future.
Okay. Now we're moving on to some other features that one would want to keep in mind when they're looking at a plan. Vesting and portability. So vesting is how long you have to be in the plan in order to receive benefits. That's one part of it. And then what about portability? And this is a big factor for doctors.
Yeah.
So how easy is it to get out if need be and preserve the benefits that are there if you take a job in the US or you move to another province or something like that? So again, these are things that you will take into consideration when you're looking at a pension plan. Payout options.
Okay.
So we've got lump sum versus annuity and flexibility.
Right. So generally, the defined benefit pension plans pay out like an annuity in a sense that they're paid out in regular payments over someone's lifetime. They do not generally pay out as a lump sum. In certain circumstances, it's possible to get a commuted value in the form of a lump sum, but that will probably be going into a locked-in vehicle, and then there'll be restrictions around that.
But I think for people that are looking at this, if I were one of the viewers, I would want to know every month I'm going to get a certain amount of money
Exactly.
to cover.
Yeah.
All right. So in addition to CPP, for example, in addition to OAS, if I'm still getting it, then I'm going to get a lump sum out of this.
Get a regular payment.
A regular payment.
That's right.
Thank
a regular payment
I
for
was
as
just
long
seeing
as
if
you
you were
live.
awake on that. Okay, good. Okay, very good. So those are the payout options, and then this risk management is a big feature.
Yeah. Yeah.
So there are three types of risks. You may not be able to articulate what those risks are, but on the slide you'll see one, there is longevity, second, inflation, and third, investment risk. So investment risk is, well, how risky is this pension plan, and what's the likelihood that it's actually going to go belly up? That's the investment risk in comparison to if you took the money and invested it yourself. Longevity risk and inflation risk.
Okay, so longevity risk is huge. It essentially means that, will you be able to have enough funds to fund your retirement as long as you live? And if you have a defined contribution plan or any kind of savings plan that you're relying
RRSP.
on, RSP in
Yeah.
retirement,
Yeah.
you are taking that longevity risk, okay?
Yeah.
By participating in a defined benefit pension plan, you are passing the longevity risk on to the pension plan.
Yeah.
Okay? That payment will be there as long as you live.
Yeah. So my mom, for example, she was a teacher,
Right.
went into retirement at 63, passed away at 93, and for 30 years collected pension. And that's the beauty of this type of pension. She never had to worry. She knew what she was getting every month.
Yeah,
So
exactly. And the inflation risk as well. Even though within HOOPP it's not guaranteed, the idea is that, they will look at increasing benefits each year if there are sufficient funds. So in a sense, you're protected against inflation as well during your retirement.
they don't guarantee that, but that's
No.
the part where you were saying they've been paying out more.
They've been paying out CPI.
See, okay, so
Yeah,
talk
so they've
about that.
indexed the pensions to CPI,
Consumer price
Consumer
index.
Price Index, every year for the last 20.
Yeah. Okay. Now, the other factors, plan stability and governance. So what we mean by that is who's behind these pensions? Like, are they qualified, or how good is the governance of these pension plans? Canada Pension Plan has its own board. They are well qualified. The Ontario Teachers Pension, we keep talking about these larger plans, but this is something you want to make sure that you're not just in putting your money into a plan that doesn't have strong governance, doesn't have strong systems in place. So again, if you're trying to think, what should I be thinking about? Plan stability and governance is another factor that now that we've named it, you would probably think, yeah, of course that makes sense. But what we're trying to do here is just give you a checklist of things to consider as you look at this and other plans.
If I could just add to that regulation, because pension plans are regulated either provincially or federally. I believe this one falls under the Ontario Pension Benefits Act. I don't have a lot of information on how it's regulated, but it is what we call a specified multi-employer pension plan.
And what's the acronym for that?
SMEP.
A SMEP. It's a
SMEP.
SMEP. Okay.
So it falls under a certain type of oversight by the government, by the Pension Benefits Act. Not my area of expertise, but it's important to know that it's regulated a certain way. The way it's funded is, there's requirements within that act. So those are things that someone should look into as well and be comfortable with if they were to join this plan.
The next thing you want to think about is the tax implications of a defined benefit pension plan in general, not just HOOPP, but generally what are the tax implications. And so Vanasha mentioned earlier in terms of there's two components here. There's the employee. So first of all, we'll find here that in order to participate in HOOPP, a physician has to be practicing through a professional corporation. So there's going to be a lot of doctors who are now looking at this saying, okay, now's the time for me to incorporate if they haven't. Right. But so there are two components to the funding of this. One is off of my paycheck or off of your paycheck from your professional corporation. And so there's going to be a certain amount of money off of each paycheck that then goes to HOOPP. That is going to be matched by the employer. Now, so two things from a tax perspective. Firstly, your contributions that go into a defined benefit pension plan like HOOPP are a deduction from your personal income. So like an RRSP, you'll claim the contribution to your RPP or your registered pension plan. You might still have some RRSP contribution room available after this. That's quite possible. So you could still, if you wanted to, continue to contribute to the extent that the RPP, this defined benefit pension plan, hasn't used up all your contribution room. So if you've got $30,000 and this is $20,000, then you would have theoretically $10,000 more that you could put into your RRSP to fund it. So you have that to consider, and that's the personal income tax implication of this. And then the employer now will contribute an amount. So in this case, the employer or your professional corporation is going to match. I'm using that term match because it's actually more than match, but it's going to make a contribution of 126% of what you've contributed. So if you put in $100 into it, your corporation is going to put $126 into it, and that will be the funding. So and your corporation will be able to claim that portion as an expense to it. So you get to claim it on your personal tax return, and your corporation gets to claim its contribution in the calculation of corporate tax. So that's while you are still an employee, still contributing to it. And then the taxation of it when you collect is as you receive the benefits during retirement, then you pay tax on that. So anything else?
Just a comment on the RSP room. So the RSP room is actually affected by something that we call the pension adjustment. So it's not the amount that you contribute into this plan. It's actually a number that they calculate and will be put on the T4. So, if you put $12,000 into the plan one year as your contribution, that is not the amount that comes off your RSP room. There's actually some notional calculation that's called a pension adjustment. But yeah, that's something
why you
we'll
get
get
paid
into later.
the big bucks.
There you go.
All right, there you go. So those are the tax implications, and then early retirement provisions. So if you're participating in a defined benefit pension plan, how early can you start to draw on it? Again, that's another consideration whether you're looking at HOOPP or anything else. And so there's early retirements, and then there's bridge benefits. Talk about bridge benefits.
Okay, so bridge benefits actually provide additional benefits for anyone who starts their pension, I believe it's before the age of 65. Because of the fact that CPP and OAS start at 65, what they want to do is give you a little bit extra benefit so that you're not just living on the pension and waiting for your OAS and CPP to start at age 65. So it is included in HOOPP, and most defined benefit pension plans have some type of bridge benefit.
Okay. And then the last item in here is inflation protection, which I think we've talked a little bit about already. So just to review what we've gone through, the plan funding and solvency, the benefit formula, the contribution structure, the vesting and portability, the payout options, the risk management, plan stability and governance, tax implications, early retirement provisions, and inflation protection are 10 factors that you now have in your toolkit to evaluate HOOPP or any other plan that comes along. So we wanted to leave you with that before we got into the analysis of HOOPP itself. And so that's where we'll start here. So what is HOOPP? HOOPP is a plan that, as we've mentioned, is a defined benefit pension for healthcare workers in Ontario. It's been around for 60 years. And if you worked for not every hospital, but hospitals that were participants in it, you didn't, as an employee, you didn't have a choice. You had to pay into HOOPP. So HOOPP is a multi-employer defined benefit pension plan, and multi-employer meaning it's made up of a lot of different hospitals and healthcare organizations. And now it's being made available to incorporated physicians. And it's a private trust fund operating on a not-for-profit basis. So that is what HOOPP is. Now,
yeah, so some of the highlights are it's got over $112 billion in assets.
That's billion?
That's billion, not million, billion. That's a lot.
Mm-hmm.
The funded status we talked about before, it's currently at 115% of the funding that it needs to meet all of its obligations based on its latest actuarial valuation. There are over 670 participating employers. Which is a lot. And so most of the major hospitals are there. You find other just local healthcare networks, Alzheimer's Society, like just any organization that has healthcare as its mandate can join HOOPP and become one of these participating employers.
I'm just wondering if like accountants who serve healthcare, whether we can qualify for that.
Oh, we can find out. We should ask.
And how many members?
So there's 460,000 members in the healthcare community that participate in HOOPP. So those would be active members who are still working and also pensioners. And that's just Ontario. This is just an Ontario plan. So that's a really large number of people who are covered under this pension plan.
All right. So that's a little bit about HOOPP. And so now here's our checklist of what we're going to do as we talk about HOOPP specifically. So we've got the background in terms of pension factors to consider and so on. So now let's dig into some more details on this. So an overview of member benefits. Banasha, can you talk to this slide?
Sure. And this is just to restate that, this is a defined benefit pension. So that means it provides a stable retirement income that's based on a formula. Okay, a formula that's based on salary or earnings, not on market returns, and generally covers a cost of living adjustment in retirement as well.
So just to draw the distinction there, this is based on how much money I've earned, not on how much my investments are generating.
That's correct.
Okay.
Correct, yeah.
Okay. Now, Banasha, is this, in your judgment as an actuary, do I want to put all my money into this plan?
Well, that's the interesting thing, because as a physician, you don't have to.
Yeah.
Right?
Yeah.
You actually have the choice, and we'll look at earnings in a minute. But it is a good piece to incorporate in your retirement planning. It doesn't mean you have to put all your money in here,
Yeah.
but it can be one of many pieces that you use to build your retirement portfolio.
Okay, so speaking as an actuary, speaking as someone who is looking in terms of retirement planning for other people, what's important to you when you retire?
So to me, when I look at retirement planning and how you want to build a retirement plan and the income that you need during retirement, I always like to think that there's a guaranteed portion of your retirement income that would be enough to cover your living expenses. So if you added in CPP, OAS, and another source like a defined benefit pension plan or an annuity, but something that pays you a fixed amount for the rest of your life, that should be able to cover your fixed living expenses. The nice thing would be then to have other funds whether those are RSP funds, non-registered funds you've saved, real estate that you've invested in, just other assets that you can then use for your discretionary spending. But the nice thing would be to just know that you have a paycheck coming in every month, and that is going to pay your bills, and you won't end up living in your children's basement.
And you're not worried about, if I live another 10 years, I'm running out of money, and where am I going to? So I think the balance here is, for some people, they will want to say, let me put all of my money into it. Other people will look at this and say, as long as I know if my living expenses are $10,000 a month, I've got $10,000 coming in. And then the rest of the money that I have in my professional corporation that I've saved, or in my RRSP, can be for vacations or for things like that, where I have peace of mind at a stage of my life where I don't need to stress about how long I'm going to live, right? And whether my money will run out. Okay. All right. So anything else on that slide, or have we covered everything that we want to?
Yeah, I think it's just also the fact that, if you don't want to manage your own investments, this is another thing. You're transferring the investment risk and just the investment decisions to investment professionals who will take care of this.
That's what you do in many respects, in terms of as you guide clients, right? And so this is an option. And I guess what I'm saying is, a plan like this actually goes against your business model.
In a sense, it does.
Right. I guess there's not too many financial advisors who are thrilled that this has come out, because this is a very interesting option.
Yeah, exactly. But it's the right option for some people. And most financial advisors should look at each client's individual circumstances and take a look at this and determine if this is a good piece to use, or a good plan to use as a piece of that person's retirement plan.
Now, an overview of member benefits continues on this slide. So there are tax benefits that we've talked about, or tax advantages, that there's tax deductibility. We've already talked about that to you as an individual contributor, as well as your corporation, your professional corporation. And this pension also is eligible for income splitting in retirement. Another factor we didn't mention beforehand. Now, what about retiring on your own schedule? When's the earliest and when's the latest somebody can contribute to this?
Okay.
Or not contribute,
but actually retire. So members can retire as early as age 55. If they have 30 years of service at that point, it's an unreduced pension. But if they don't, there will be a reduction in their pension that they've earned to date, because they're starting it earlier. They're going to get it paid out to them for more years than if they started at a later date. One thing that I found interesting with HOOPP is that the normal retirement date with an unreduced pension is age 60. And I found that to be almost low compared to other defined benefit plans I've seen. Often it's age 65. And anyone retiring before age 65 who didn't have 30 years of service or an age plus service number would have a reduction. Okay.
You could go as low as 55,
could,
so there's going to be a discount on that benefit because they're paying out longer.
Yeah, exactly.
Okay. All right.
You can also defer the pension as late as age 71.
Okay.
So that does two things. First of all, it gives you more years to earn pension, so it'll be a higher pension, but you're going to start drawing it later in life. There is, I believe, also an adjustment upwards, similar to CPP. If you defer your CPP pension beyond age 65, the pension is actually increased, and HOOPP has some type of provision like that. Right.
And the other thing you're going to see, whether it's HOOPP or any other pension plan or RRSPs, they keep referring to the age 71, and age 71 is where you now are converting at the latest and starting to pull out. RRSPs, for example, you have to convert an RRSP into a RIF when you're age 71 and start to pull it out. So all of these types of plans, like HOOPP and so on, are kind of built around the model of RRSPs and so on. So that's why you'll see these dates, because they are kind of coordinated. The government, in its tax policy, is trying to make sure that you, Benasha, don't have an advantage over me, because you have access into a pension plan and I have to fund mine through an RRSP, for example. That's the rationale behind this.
Yeah,
right?
and at some point they want to start getting tax
Yes, of
on
course.
the income that you've been deferring, or the contributions that have been deferred,
Yeah.
tax deferred for so many years.
Now, in addition to these others, the tax advantages and retiring on your own schedule, then there's protection through disability and survivor benefits.
Yeah, and we'll get into a lot
Yeah.
of detail of those, but HOOPP does include both disability and survivor benefits.
Now, those are just words right now. We're going to see how that impacts because it really surprised me when we saw this. All right, so we are now going into the eligibility factor on our checklist here in terms of who can participate in HOOPP. So HOOPP, as you are all aware, is now available for physicians who are operating through a medicine professional corporation. This is not available for somebody who's a sole practitioner. They must be operating through an MPC for this to work. They practice in Ontario. They can draw dividends if they want, but dividends are not going to help them towards their benefit.
That's right.
So it must be salary.
Yeah.
All right. And then the final piece is that you become, if you're not already, a member of Ontario Hospital Association. So those are the criteria. If you've satisfied each of those, then you're eligible to join the HOOPP plan. All right, now we're going to get into this slide, which is the pension benefits calculation. So we're going to walk through the calculation, and then I'm going to jump in with some questions.
All right, so you want me to do this, or you're
You
the
do it.
numbers person?
No, you go ahead, and then
Okay.
I'll ask questions.
All right. So this is, in a nutshell, how someone would calculate what their annual HOOPP pension will be. It's essentially the number of years of service they have in the plan. And then there's sort of a two-part formula. So first of all, YMPE is the year's maximum pensionable earnings. That's a term we use, or that Canada Pension Plan uses. And that's essentially the number up to which you contribute for a Canada Pension Plan. I'm not going to talk about the excess amount right now.
Yeah, but just to jump in there, when I'm doing tax planning with clients, and sometimes a client will say, well, I don't really need too much money out of my corporation. I will
Right.
say to them, at least this year, take out $71,300 in salary so you contribute a year. That amount is the maximum pensionable earnings to collect a year of CPP benefit in retirement. So it's the same kind of concept here that we're looking
Exactly.
at, right? So
Yeah.
yeah.
And so to a certain extent, this pension is integrated with Canada Pension Plan payout. So there's a certain percentage that's earned in terms of a benefit up to the YMPE. So it's 1.5% up to the YMPE. And then any earnings above the YMPE, the benefit is calculated as 2% of that amount. So the best way to explain this is with an example.
All right, so let's go there.
Yeah. Okay. So let's say that this member has a best 5 years average earnings of $150,000. And
out of 25 years.
out of 25 years,
Yeah.
yeah, which we would expect would be at the end of their career.
But not necessarily.
Not necessarily.
Okay.
Yeah.
Okay.
Yeah. And they've got 25 years of service, and so we're looking at $150,000. So we know the current YMPE is $71,300. Okay. So using the formula above, the pension benefit is calculated to be $2,644 per year, and then when we multiply that by 25 years of service, the annual HOOPP pension that they're looking to start with, if they're retiring this year, is $66,088.
So that's the amount that they would get. That's the starting point for the rest of their life, and that might be indexed.
Exactly.
Okay, all right. And that's just up to the yearly maximum pensionable earnings figure of 71.3.
No, that includes. the
Sorry,
full
you're
amount.
right. That's
Yeah.
based on 150.
That's
You're
based
right.
on their full earnings.
Yeah, okay. All right, so in addition to them collecting 16 or 17,000 for CPP,
Yeah.
they would have 66 here, maybe 8,000 on
From
OAS.
OAS, yeah.
So they're at roughly $85,000.
Yeah.
Okay.
Yeah.
Now, just compare this to CPP. In other words, if I have earned $71,000 and I've worked for X number of years, can we convert this into a comparison between the payout of CPP in comparison to the payout of HOOPP?
Yeah, in a sense you can, because if this person, again, let's say they had maximum years of participation at maximum earnings for CPP.
Yeah.
then their CPP would be at the maximum in the year they retire, which is 25% of that YMPE. So 25% of the $71,000
is $17,000, almost
Exactly.
$18,000.
Exactly.
Okay.
And that is a lot less
Yeah.
in terms of a formula, and that's based on about 40 years of service.
Yeah.
This is based on 25 years of service.
So that's a very good point. You're paying in longer to get at that.
Yeah.
And you're only getting $17,000, which is going to be about 25% of the total amount this person is going to have in their retirement. In other words, what I mean by that is they'll get 17 out of CPP.
Right.
They'll get 66 out of HOOPP, and they'll get 9, say, out of OAS. So for not much more money, look at how much more somebody is going to get out of HOOPP than they would out of, say, CPP.
Yeah.
And for working less. Now, less period of time. Now, for somebody, and we'll get into this, the real driver on this is years of service. So if somebody is in their late 50s or early 60s and saying, well, should I participate in this? It would still be, we'll see, I think as we go through, it would still be a good plan for them, but their limitation is going to be their years of service.
Exactly.
They can't go over age
can't go over
71,
age
so if
71.
somebody's 61, they've got 10 years of service in here multiplied by that, and that will drive their pension.
That's right.
Okay, all right. Now, so have we covered everything we want to cover here or not?
Yeah, this is actually the contributions now.
Yeah.
Okay, so this is an example of how you would determine how much you would contribute in 1 year to HOOPP.
Yes.
Okay, so the formula that they use for contributions is based on earnings, and we're going to get to earnings in a minute. It's 6.9% on annualized earnings up to the YMPE, so the YMPE plays into this as well, and then 9.2% on earnings above the YMPE. So that is the employee or the physician contribution. Then the employer or the MPC will also contribute 126% of what the member has contributed. So if we look at this sample calculation, we're going to use the same $150,000 of earnings. The member contribution, using that formula that's split by above and below YMPE, it calculates out to be $12,160. Okay, so in a year that a physician has $150,000 of base earnings, what will be deducted from their pay and from their personal taxes will be the $12,160.
So $1,000 a month.
Exactly.
Okay.
Okay.
All right.
And then 126% of that is what the MPC will pay.
So
and-
about $1,200, $1,300 out of the PC.
Yeah,
So
exactly.
between the two, it's about $2,200, $2,300 to contribute at that level.
Yeah, per month. So
Okay.
a total of about $27,482,
Okay.
which actually looks very close to the maximum RSP contribution. If
Okay.
you look at it.
Now, the way I'm looking at this from the comparing to CPP, because this is what I want to, I always want to make CPP real for people in
Okay.
terms of how much it costs them. If you're an employee of your professional corporation and you're earning $71,300 a year, which is the point at which you would max out in contributing to CPP, you would be paying 5.95% as an employee. So here it's 6.9, so slightly higher by a little less than 1%. And then your professional corporation would also be contributing 5.95%. So it's just under 12%. Compared to if you add the 6.9 to 6.9 plus 126, sorry, I should have calculated, but it's about 9%. It brings you at about just under 16%. So CPP per dollar of earning is just under 12.
Yeah.
This is just under 16. So it's quite close, right? But the advantage with this, of course, is you can have a higher level of income driving your benefits as well. So. All right, so we've looked at, just to recap where we've been so far, now we're getting into a really important part of this, which is the first decision you have to make if you decide to go in here, because you're going to have to live with that decision. So it's determining your baseline earnings. Do you want to talk us through this?
Yeah. So this is actually a really interesting part of the offer for physicians.
You're an actuary, though, so I mean...
It's fascinating.
Okay.
So the fact that you have flexibility to choose your year one baseline earnings Whereas if you think about, someone who works at one of the hospitals and is a member of HOOPP, they don't have that flexibility. They are
Whatever they earn is
whatever they're earning. Their salary is their earnings in the plan. Okay, so but it's also really important to decide how much you want to choose as your baseline earnings. First of all, they can't exceed your actual earnings. So if you've been pulling 120,000, let's say, on T4 earnings from your corporation, you can't say, I'd like to make my baseline earnings in HOOPP 150,000. You can't go above what you're already earning. You also want to think about, will you be doing that consistently over the coming years? Because you don't want to later on drop your earnings, and while they'll allow you to continue participating in the plan, it will affect the amount of service that you are actually accruing.
Okay, so if I'm taking 120,000 from my PC and I use that as my baseline earnings, because I can't go higher than that,
Right.
but I could say no, I just want to go for 100
Right.
as long as it's lower. But if 120 is my starting point, but then I drop down to 110 or drop down to 105, I've got a problem.
It's not really a problem. They
Okay.
will still let you participate.
Yeah.
There's a little bit of a margin. I think it's actually CPI
yes.
plus 1%.
Yes.
So let's say we're getting very technical here.
Yeah,
but
but there's a 3%.
There's a 3% window.
Okay.
So
Okay.
as long as you stay within that,
Yeah.
they're going to give you a full year's worth of service.
Yeah.
But if you drop from 100,000 to 80,000,
Yes.
they'll just deduct your service 20%.
So on the
for 1
slide,
year.
we'll use the 2025 figure of $100,000, and let's supposing in 2026 your salary from your corporation is $98,000.
Yeah.
You're still okay.
You're still fine.
You're within that 3%, or
Yeah.
and it doesn't really matter above, right? I guess it does, though. They still give you the benefit.
Okay, so what they're allowing you to do each year is increase your baseline
Yes.
earnings by an amount no more than CPI plus 1%. So if we assume CPI is 2%, let's say in this example, the physician has $100,000 baseline earnings that they've selected for 2025. Then in 2026, they can say, well, I'd like this year's baseline earnings to be 103. Okay, and they have to take that out, at least that much out on their T4.
Yeah. Even though they've taken 100, they can still report it as 103, or
No, they have to take.
they have to take 103.
I believe they have to take 103.
Okay.
Then the following year,
Yeah.
they can go another 3%, and now they're at 106.
Got it.
And the reason you want to do that is because your pension is then going to keep pace with the increases in your salary.
Yeah.
If you always keep it, you're allowed to keep it at the same baseline earnings without any increases. But 25 years later, your pension is going to be based on 100,000 and not on the final average amount, which could have been indexed to
Right.
CPI.
Right. So I start in 2025. By 2040, I've actually, as long as I'm still pulling that out,
Yeah.
that's my basis
Yeah,
for a pension. Now, I'm going to have to pay premiums on that.
exactly. Premiums
So
will increase.
It'll continue to increase, but
Yeah.
nonetheless, I'm still keeping up. All right. So here's where we're at now. We want to talk about survivor benefits, and this is why I said these are words only. But let's talk about survivor benefits because there's two scenarios here that we've thought through. So talk about.
Okay.
This.
And, again, I'm not an expert on HOOPP, but this is what I've been able to gather from the website, and I've also had a discussion with some of the people at HOOPP to clarify this. Because one of the concerns that we keep hearing is that, well, I'm putting all this money in, what if I don't live very long? Where does all that money go? Does it just go back into the pool and support other members? So there are survivor benefits, and it's sort of two ways to look at it. If there's an eligible spouse at the point that a member retires, there are spousal benefits, survivor benefits, and the normal form is a pension of 66 2/3 of the retirement pension the member was receiving after that member passes away. Okay? So, but if the member passes away within 5 years of retirement, the pension to the survivor actually remains at 100% until the end of year 5, at which point it drops to 66 2/3.
So if the pension payout is $100,000 a year,
Yeah.
and this person has the member of the pension plan has passed away within that 5-year period, their spouse would still get $100,000 for that 5-year or
Yes.
up to that 5-year period, and then at that point they would go down to $66,666 a year. Okay.
Yeah, and they would continue to receive that as long as they live.
For they live as long. Okay. All right.
Now, the other thing that can happen is at the point of retirement, the member can actually choose a different percentage for the survivor. There are several options there. But what that would mean then is that the pension that they start at would be adjusted. So, for example, a member may say, I'd really like my spouse to get 100% of the pension after I pass away. I don't want it to reduce to 66 2/3. That is available, but their starting pension would be lower.
Right.
So there would be an adjustment to the pension.
So you're absorbing, you're taking a bit of a hit as a member to ensure that your spouse can continue to enjoy the same benefit, and that 66 2/3 doesn't come into play
Exactly.
at that point.
Yeah.
Okay. All right.
And then the final thing is a member can actually waive the spousal benefits altogether. There are various reasons they may wish to do that. There are also, there's legislation around this. I don't want to get into it,
Yeah.
but there would have to be agreement by the spouse and so on. But there may be situations where someone would want to do that. And that actually leads us to the next scenario where there is no eligible spouse, or if someone has chosen to waive those benefits, there is then a 15-year guarantee on
Yes.
the payments.
So we'll talk about scenarios, but I just want to bring into this a scenario I had the other day with a client who was saying, "Listen, I'm a single parent in this case, and I don't really feel that I want to participate in here because I will have paid in all of this money." And there's a slide that shows how much somebody would contribute into this. Why would I pay into this when I can't use the survivor benefits because my child is not my spouse? And so for that reason, that you could choose to waive those spousal benefits, but then have this this other no eligible spouse option, where then the child in this case would stand to benefit for 15 years of payout.
That's right, yeah.
That's a pretty amazing amount.
Yeah, so if, let's say, this person started their pension at age 65, they
Yeah.
passed away before age 80,
Yeah.
the remaining payments in that period would go to the child, or there'd be a commuted value.
Yeah. So the concern this person had was, I'm going to lose money on this because of my family structure.
Right.
No, you're not.
No.
And so that's a pretty impressive feature here.
Yeah.
Right. So it does protect it to the next generation with that feature. All right. Now we're going to go into disability benefits under HOOPP.
Okay. So the main feature with a disability benefit is that if someone is determined to be disabled, so you'd have to meet certain qualifications, then HOOPP accruals, meaning years of service, will continue to accrue without paying contributions. Okay, so if you're partially disabled or totally disabled, you would apply to HOOPP and say, I'm disabled. If they approved, that you met their definition of disability, then they would say, fine, we're just going to continue to allow you to accrue pensionable service so that you don't miss that time.
This is like a long-term disability provision within HOOPP.
Yeah.
If something happens, then it's not going to impact. It's beyond your control as long as you meet that criteria.
Yeah.
Then that mechanism will preserve your income.
That's right.
Okay.
Yeah, yeah.
Anything else in terms
So then if you actually are totally and permanently disabled, again, they have to assess it and approve that. You can either receive the free accruals of service or actually start an unreduced pension. So, for example, if someone was disabled around age 60 and it was pretty clear that they were not going to go back to work, they could actually start their pension early. Let's say it's actually before age 60 because they can get unreduced pension at age 60 anyways. So a 55-year-old may be able to start an unreduced pension if they qualify as permanent and total disability.
So you've got protection in the event that something happens to you, and the money that you've put in isn't forfeited. Your benefits claimed out is not diminished as a result of this. Another important consideration. All right, now we want to get to some practical scenarios, and so we're gonna start with the scenarios that you found in the package. If you've looked through the HOOPP website, This is a slide you will have seen there. Banasha, walk us through this.
Okay. So this was an example of a doctor at the age of 40 who joins HOOPP and contributes to age 65. So she has a total of 25 years of service. She also contributes up to her maximum allowable amount each year. And what that means is if we assume CPI is 2% every year, she actually takes that extra 3% increase each year and contributes up to that. So let's just look at the 100,000. She can choose her baseline earnings.
Right.
They've given us 3 examples here, but we're going to look at the $100,000 case. So in year 1, if we calculated both her contribution and the MPC's contribution, it's $17,086. Okay, just to give us a sense of what it starts out at. But if we look at all the contributions that she will make herself to age 65, accounting for that 3% increase each year, it's about $275,000. And then the 126% that the MPC is putting in is $347,000. Using that final average or that career average best 5 years benefit formula that we looked at earlier, her starting pension at age 65 is $78,797. And if we look at just what she would receive in 15 years, if she lived to age 80, and we're not including any indexation here because that's not guaranteed.
Even though it has been indexed for the last 20 years, but that may change.
Yeah, we're
that
not going to include it there.
Okay.
It's almost $1.2 million in payments that she's receiving.
Now, the corporation and her have put in this case, $625,000 roughly. Right. So they've made back that and then a return.
Right.
Now, what happens if the person starts collecting at 65 and something catastrophic happens at 67?
Okay.
Do they lose all that $625,000?
No, that's where if she has a eligible spouse,
yes,
they would then get that survivor pension.
Right.
So at 100% for the next 3 years,
yep,
reducing to 66 and 2/3.
So they will have gotten $210,000, let's say, roughly, and then they will get 66 and 2/3 for the rest of their life.
That's right.
What about the person who has waived the spouse benefits and they are, say, a single parent and they've got kids?
Right. So
what happens then?
So we can see from age 65 to 80, that's 15 years.
Yep.
So the balance of whatever was not paid of that 1.18 million is probably commuted or could be paid out regularly still to the beneficiaries or to the estate.
Yeah. So they will get 1.8 million for $625,000 of contribution.
1.18 million.
1.18.
Yeah.
Yes.
Yeah.
Yeah. So I guess my point is, there really isn't a downside risk here that somebody's going to lose money as a result of this. They've got to pick the right provisions, right? Either spousal or non-spousal, but the family will not, the estate of this member will not be diminished by the contributions they've made here.
No. I mean, there is a chance if you had a spousal pension and both passed away within 5 years.
That's true.
Okay, so it's possible that would not recoup all the contributions made. That's a risk. That's definitely a potential risk here. But that risk exists with the reward of longevity.
Yeah.
That this could be paid out to age 107 if you live that long.
Yeah.
Actually, if you go to the next slide, we can look at some of these numbers again. So we calculated a starting pension of $78,797. Contributions over 25 years, $622,000. So the break-even year really is 8 years, 7.9 years, when all the contributions have been received back.
Right.
If she lives to 85, that's still not even life expectancy. Total payments would have been 1.57 million, unindexed. Okay, we haven't included indexing.
Right.
If she lives to 95, total payments 2.36 million.
So I just know there's some people out there who plan to live a long time. What would it be, Banash, if it was, say, 120?
Where's your calculator?
Okay. All right. Okay.
You get to do that now.
Okay. Now, other considerations. other things that people need to take into consideration.
Yeah,
here.
and I actually want to address something you mentioned, is that there's no downside. So someone might view a downside as, okay, I put 622,000 in here.
Fair enough.
You're saying I break even after 8 years, but there's a lot of lost opportunity cost.
I
What
could
if-
have invested into something else and done
Exactly.
better. Okay.
And that's a big consideration.
But
for
there's
people.
also risk that goes with that.
There's risk that goes with
Yeah,
it, but some people are comfortable with that risk.
Yeah.
So this is not the be-all and end-all. This is, a different type of asset class.
Yeah.
It works for some people. Other people would rather invest on their own.
Right.
So, yeah.
Some people have flagged the fee for OHA. I think it's $1,250,
Yeah.
$1,251 a year
Yeah, that's
to be
what
a
we were
member.
told, yeah.
Okay, and that's what when you spoke to HOOPP, that was the figure they
That's
gave you.
right. And it's important to note we haven't included that fee
Right,
in our numbers here.
Right, fair enough.
Yeah.
Fair enough. So if somebody is in retirement collecting a pension, do they still have to be a member?
Yeah, that's a good question. I don't know.
We'll have to put that
We'll
down
have to
on our
put that
list.
on our list.
So we've got a list of questions now as we've been going through this. We're going to go back to HOOPP. We hope you've got some questions that we can add to our list tonight and go back and get some answers. It's quite possible we might reconvene another webinar just because this is such a topic of interest. All right. Anything else here? We've talked about survivor benefits indexation, which hasn't been factored in here. So let's go on to our next, which is deciding on HOOPP, and we've got 6 scenarios here. So I don't know where you want to start. Parental leave, what happens?
Yeah, so parental leave, my understanding is that that can be bought back. So if someone is on parental leave for 6 months, a year, they're not contributing to the plan during that time, when they come back, they can actually buy back that service. So they will have to contribute, and there may even be a provision that they can actually contribute while they're on leave. But it's not lost time.
Okay, but what about if their income's lower though? Because they would have been making $100,000 and now they're only making $50,000 because they've been off. How does that work?
I have no idea.
I
We
think
have
you
to
said
see.
that they gave you like the equivalent of half a year,
Yeah.
so that it didn't actually that 50,000 would effectively be annualized to
Yeah.
100,000.
It could be annualized to 100,000, so it would be
Right.
a half year.
Right.
But parental leave provisions might be different even for MPCs.
Right.
So it's a good question for us to ask.
Right. Okay. Single parent, single person, single parent. I think we've
We
talked
covered
about that a
with
little
the
bit.
15-year guarantee.
That's right. Somebody who is now taking a position at the at the Mayo Clinic
Okay.
in the U.S. What's the implications for them?
So again, I think it would be very similar to any other defined benefit pension plan. It could be frozen, and they could likely collect it when they actually retire,
Based on what they contributed.
based
that
on what
would-
they've contributed to
Right,
date.
right,
Yeah.
okay.
And so it'd be frozen, invested. I think they could probably also get a transfer out of there, but it would be
into a
transferred
401k
into
or something or
yeah,
other
Yeah,
in the
but
US.
these are things that would be
Yeah.
on a case by case.
Yeah. Okay.
But they're not losing what
Okay.
they've put in.
Now, another scenario was somebody who, and I've got there are a few files that I have that are like this, where somebody is already on salary at a hospital or a clinic, and so they're already, by virtue of being in that capacity, they're participating.
Right.
But now they say, you know what? I'm only working 4 days a week. I've got an extra day I could go and work at a clinic. I could keep my professional corporation or set up a professional corporation. Could they then contribute to HOOPP through that corporation if they wanted to top up?
Again, another good question
Yeah.
we have to ask.
Okay,
Because
okay.
I can imagine there'd be a lot of situations like that.
Right. Especially if somebody moves from one job to another, that would be another scenario where maybe they go into practice. So I can't well, we shouldn't speculate. But
Yeah.
Okay. Another one, which is somebody who's 30 years old, wants to buy a house, is watching their finances and their cash flow. Should they enter into HOOPP now at this stage, or should they put it off? What do you think?
Okay, that's a good question. I mean, it probably would be the same question as whether they invested in RSPs or not. But I don't think we know whether HOOPP is giving physicians a window
Yes.
in which
In
to
other words,
enroll.
the offer may
Yeah.
have a limit.
That's right.
Yeah.
So that's something we need to find out. But if that 30-year-old physician really needs to save money for the down payment
Yeah.
and can join in 2 or 3 years, that could be a consideration
Yeah.
as well.
You know, I will always say to new to practice physicians that the first question you should be thinking about before anything else, before whether I should incorporate or buy a new car or something like this, or buy a house, oftentimes, is how much money do I need to retire on? And HOOPP did us a great favor by making this now an option, right? Because I was always saying, and I continue to say to new to practice physicians, you need to know how much money you are going to have to retire on by the time, or you're going to need to retire at age 60 or 65. If you're not going to use HOOPP, which is fine, that's definitely an option. You still need to be saving $2.2 million if that was the number based on their living expenses or so on. So I always say to my new to practice physicians, retirement is number one priority. Now the challenge I have is right now somebody can put $60,000 into their RRSP. They can put $40,000 into their first time home savings account, get deductions out of that, pull the money out and use it. So it is a bit of a balance, or it's a bit of a balancing act now, isn't it?
Yeah, no, it certainly is.
Yeah, so.
Yeah, and if you put your money in here, you can't borrow it out.
You can't pull it out.
But whereas in an RSP, you can borrow it and use it for the home buyer's plan.
For the home buyer's plan, yeah, that's right. Yeah. So, but again, I think the point that I'm making to people is don't get into the lifestyle expenditures without first knowing how much money you're going to need to set aside for retirement. We saw in here, if somebody was to join HOOPP at 100, it was going to cost about $27,000 a year.
That's right.
Between them and their corporation.
Yeah. If I can make another point on the 30-year-old, it may be that at that point in time you're not clear on your career path, that maybe you will be leaving the country, maybe you'll be, who knows what you'll be doing. So that may be another reason. If you don't have to make a decision to join HOOPP, you might want to wait a little bit just so that you're more clear, so that you're not doing HOOPP for a couple of years, then it's a frozen benefit that you'll connect or collect later on. Yeah.
All right, now moving on to our next. Oh no, we've got one more scenario. Somebody who's late career, 61.
Yeah, there's actually no reason that I can see to not join. Because the nice thing about joining at an older age is you're paying the same contributions to buy the same benefit, like dollar value benefit, as someone who's, let's say, 30 years old. But you're going to collect it a lot sooner than them. So it's actually more valuable. Yeah,
it's a better return on investment, isn't it?
Exactly.
With security.
Yeah, that's right.
All right. Now, so advantages of a defined benefit plan, we've talked about these. That it addresses longevity risk. It provides a degree of inflation protection, flexibility in when to start the pension, survivor benefits, buyback pensionable earnings, and then terminate membership. What were we talking about there?
Just the fact that if you did have to terminate your membership, you could get a commuted value.
Yes, okay.
It's not as if you're walking away from your contributions.
Right. And then we've got potential advantages to physicians and potential disadvantages. So I think we've covered these. This is really just reiterating what we've talked about before. Disadvantages, the cost in terms of like the annual fee, that OHA fee, the effect it might have on RRSP contribution room. Talk about that for a second.
So essentially, some people like investing in RSPs. They want to have that
control. Like investing.
They like investing.
Yeah.
And this will leave you with a lot less RSP room. Yeah. So it's important to look at that.
Yeah.
And that leads to the lack of control, too, over your funds.
Yeah, you're surrendering your funds over to an entity that's going to invest it for you and make sure there's enough to cover you.
Yeah. I'll just want to make one more point there. Yeah. The ability to choose, okay? So I think this is really important because you're not forced to join this plan. Membership is not mandatory. If you were an employee in a healthcare organization that's a member of HOOPP, you don't have that choice. So the fact that you are able to choose and you're actually able to choose your baseline earnings as well, actually puts a lot of the power in your hands as to whether this is a good decision for you personally, right? And that means taking all your circumstances, into account, including things like, just your view on your own longevity. If you think you're going to live a long time, you might want to choose to join. If the opposite was true, probably not. You can make choices about your survivor pension. So the fact that you can actually control a lot of your own the features around your membership here, should not be discounted. Yeah,
and I do hope that, because I've had some conversations with some folks who who just are struggling with the fact that they have to be a member and pay membership. I'm really hoping people are going to see past that. I mean, nobody's telling you you have to participate in this plan. Honestly, as two people outside of this who couldn't, that wouldn't even be a thought on my mind or in my mind in terms of what a plan like this has to offer. So, but for some people that is a factor. But as I say, nobody's telling you have to join this. So, all right, we've gone through all of our outline except for next steps. So one of the things that we wanted to do, here's our questions so far, and I think we've picked up a little bit more tonight, and we'll pick those out of the recording. But do you have questions? And we will not necessarily have the answers, but what we will do is go back to HOOPP for the answers that we can't give you tonight and put those questions to them and let you know. So that's what we were planning on doing. And then next steps, now that we're drawing this presentation to a conclusion, and now's the time we will start to look for questions if there are any, is next steps for you. So, assess your interest in, are you eligible? If you're not, what do you need to do in order to become eligible? If HOOPP is something that appeals to you, incorporate, for example. The big question is, what's your baseline earnings? That's a big decision to make. And then consult with HOOPP. Schedule a consultation with them to explore more personalized options. I talked to a client today. They had just signed up with HOOPP, and they just talked to somebody there, and so just had enrolled. So and then enroll in HOOPP if you're interested, and then reassess your overall retirement and estate plans. This is a good time. You're thinking about this. Have you got your wills in place? Have you got powers of attorney? Have you been thinking about setting up a trust, if that's something, or long-term care considerations? This is just part of a longer-range retirement plan to take into consideration. If you want more information on this, here's some resources that you can follow up with, and I think that's our presentation in an hour and 6 minutes. Now, for questions. All right, so here they come. Can you change the spousal benefit percentage after starting retirement?
No, I think you have to make that choice at the time you start your retirement pension.
Okay, I'm going to add to that, can you make a decision in the case of marriage breakdown, for example, where do you think you can name more than one spouse in a family breakdown where up until a point they've had entitlement, the former spouse has had some entitlement, and now somebody else enters into that? Do you know or not?
No, I don't.
Okay.
Yeah.
All right.
Good question, though. We'll put it on our list.
How much of a tax advantage or disadvantage may be associated with having to pay myself a higher salary to maximize my pension? Well, I guess I'd say to maximize your pension is the key there, because maybe maximizing the level I would consider maximizing my pension might not be the level you would pick. So again, I'm not looking, in my case, or you might be different, Banash, in terms of what you would pick, but I would be thinking, what do I need in retirement to pay the bills, not to have to worry about money, and then what is that level of salary like? So for some it's going to be lower, for others it's going to be higher.
Yeah.
And so I'm not trying to avoid your question. I'm just trying to say I can't really tell what kind of tax hit, but for somebody who's drawing let's say $114,000 of salary a year, their average tax rate on that's going to be about 22-23%. That's not a lot of tax, and that would get you into a level where you're contributing and getting similar to what we were looking at, around 66 or 70,000 was depending on the number of years, right?
Yeah.
But that could be a way of looking at that. So also, it must be salary. You cannot take out dividends instead. So when you're taking salary, you are buying into this. You are spending about $8,000 a year, depending on how much your salary level is on CPP. So between somebody on a salary based on the scenarios we were looking at beforehand, where they picked, I think you picked about 100,000, that was the scenario, and it was
Yeah.
costing them 17,000 a year between their employer and employee in the first
Yeah,
year.
that's right.
Then add on top of that another 8,000 for CPP, you're up to $25,000 of pension purchase in that year. So
Maybe if I could just add to that. So if someone was taking regularly 150,000 of T4 earnings, they could actually participate at the $100,000 level, right? So they'd get a deduction off of their 150,000, which I expect would be more valuable.
say that again.
Okay, so they can participate as their baseline earnings at 100,000.
Yeah.
If they're taking 150,000 out of their corporation,
Yeah.
that's allowable,
Yes.
right?
Yeah.
So whatever they've contributed to HOOPP would come off the 150.
Right.
So there's a bigger tax benefit
Right. Because their income's higher.
because their income is higher.
Yeah. Yeah. Fair
Yeah.
enough. Okay.
And the other thing I would say there is, I think you want to take advantage of that that increase each year. So if, let's say, assuming CPI is always 2%, increase your baseline earnings by 3% each year. Because the interesting thing there is, in the early years, you're paying contributions on, let's say, the $100,000 level. But eventually you're earning a pension based on the higher amount. So you've put in some lower years of contributions, but ultimately your pension benefit is based on a higher amount. So I think you're doing better if you use that increase each year rather than just keeping it level all years.
I'm getting a couple of questions just around dividends, and again, if somebody's been taking dividends in the past, that doesn't go into the mix. If they've had a
Yeah.
professional corporation, that doesn't factor in here. So,
But I think we should ask HOOPP if someone in the next year or so starts taking T4 earnings.
Yes.
When can they join HOOPP then? If they have 1 year where they've shown T4 earnings in their corporation at
Yeah.
a certain level,
Yeah.
are they now eligible to join HOOPP?
yeah, yeah. But if they've been a sole practitioner up until that point and they've just incorporated,
Oh, yeah,
they're out
then
of
there's-
they're out
yeah.
of luck on that.
Yeah.
If one is close to the upper limit of tax bracket and salary, would increasing salary to beyond the tax bracket and ensuring baseline contributions to HOOPP then in effect bring, yes. So the question is this, in Ontario, right now, 2025, 253,000 is the upper, is the point at which you enter into the top tax bracket. So if somebody wants to participate and they want to come in at 253,000 but also fund their contribution to HOOPP, they would actually draw out more, make the contribution, so their salary might be 270,000, let's say, and then they would get a deduction for the RPP contribution, bringing their income down to the 253. So absolutely, you're not constrained by that limit, so long as you don't take more salary than would be contributed to RPP or RRSP if you weren't a member, as long as you've got the contribution room. So I think those are all the questions. We should just cut off the questions now and head out. That's it. Be done with this. So, but I don't think I'm seeing any more questions. Yep, there was just 5. So if anyone else does have any more questions, speak now or forever hold your peace. And if not, we will.
Or you can email them to him.
Yes, or to you. Yes. So our contact information is on screen there, so feel free to email us. I hope you found this helpful and enlightening, and a fascinating way to spend a cold January evening listening to an accountant and an actuary. I mean, it doesn't get
Yeah.
any better than that,
No,
does it?
for sure.
Okay. Well, anyway, thank you everyone for your interest, and we look forward to hearing from you on this and other things in the future. Take care now.
Thank you.